Welcome to Uncommon Capital Quick Takes. Short episodes, smart insights, real-world investing explained simply. In just a few minutes, we'll break down one topic shaping private markets and the economy today. When most people think about investing in a company, they think about buying a stock, a small ownership stake in a publicly traded company like Apple or Microsoft. Private equity is the same idea. It's ownership. But instead of investing in public companies, you're investing in companies that are privately held. Private equity firms raise money from long-term investors like pension funds, endowments, and ultra-high net worth individuals. They use that capital, along with a meaningful amount of borrowed money, to buy companies, improve them, and eventually sell them at a higher value. While investing in private businesses has existed for over a century, modern private equity really took shape in the 1980s during the era of highly publicized leveraged buyouts. Those deals were often associated with a heavy use of debt and what critics often called financial engineering. But over the last 3 decades, the industry has evolved. Today, private equity firms focus heavily on operational value creation. That means improving management teams, driving efficiency, expanding into new markets, investing in technology, and accelerating growth. The goal is still the same: buy, build, and sell, but the playbook has matured. Private equity has grown dramatically. Global private equity assets under management now exceed $5 trillion, and private equity-backed companies represent an estimated 7 to 10% of U.S. economic activity. Historically, over long time horizons, 20 plus years, private equity has outperformed public equity markets on average. However, over the last decade, performance relative to public stocks has been more mixed. From an investor's perspective, private equity is attractive because it offers the potential for return premiums and diversification. But it comes with trade-offs. Investments are typically illiquid, and investors can be locked up for 7 to 10 years, and are most commonly structured as limited partnerships, meaning that access is generally restricted to institutions and qualified purchasers. Today, the industry faces new challenges. Higher interest rates have made leveraged buyouts more expensive. Exit activity, particularly IPOs, has slowed, and valuations, especially in software and tech, have come under pressure. Even so, private equity remains a core allocation for pensions, endowments, sovereign wealth funds, and many high net worth individuals. It's a massive part of the capital markets and increasingly a meaningful part of the broader economy. At its heart, private equity is simple. It's about owning companies, improving them, and creating long-term value. It just happens outside of the public spotlight. I'm Brian Resnick, and this has been an Uncommon Capital Quick Take.